Welcome to Trade with Books English channel, and today we are going to discuss the chapter 4 of value investing, which we have started, where we are learning how to value a stock, a company, based on discounted cash flow model and relative valuation model. Now we are continuing with discounted cash flow model, and we have left over three pieces of the puzzle, that is expected cash flow, growth rate and terminal life. Already we have covered the discount rate in the last chapter. If you want to learn full thing, you can start from the chapter 1 itself. This all things I am taking reference of Aswath Damodaran sir's lectures, where he has explained discounted cash flow model. So now we'll start how you can know that expected cash flow. So earlier chapter I have shown you that for valuing an asset based on discounted cash flow model, if you want to get the intrinsic value of a company, of its equity part, then you have to add the expected cash flows for n years of life. That n is the asset life, and you have to reduce that expected cash flow for the risk involved. That risk is called discount rate. So earlier chapter I have explained you in detail how you can find out this R, this number R, that is called the discount rate. In today's chapter we are looking for this ECF, that is expected cash flow, and for next year expected cash flow, what should be the growth rate, and finally what should be the N, how many years you can add it. So this all three I will solve in this chapter, and then you are ready to do a discounted cash flow analysis and intrinsic value calculation for any company. So what is expected cash flow? So how much cash flow is coming in a company based on its operations after giving all the taxes, all the reinvestment need, and after paying all the debt requirement. Whatever leftover cash, that is called the expected cash flow for a company. So here you have to see four things: accounting earnings, how much of that earnings are going for paying taxes, how much of that earnings have to go for the reinvestment need for the company's future growth, and what is the debt payment requirements. After that you will get the free cash flow to equity, and this is a simple equation. Net income you have to minus, from the net income you have to minus capital expenditure minus depreciation. This is minus means depreciation you are adding, but net income minus this bracket is there, capital expenditure minus depreciation, minus this other bracket says change in non-cash working capital, and the last one says that how much debt is to be repaid minus what is the new debt issued. So one by one we will see where you can see this data and what this means. Net income, first is the net income. So you have to come to screener.in, where screener.in, suppose for Asian Paint, you have to come to profit and loss segment, profit and loss, and you have to see the TTM, means last trailing 12 months profit and loss statement, and here you have to see what is the net profit. This is the net income of the company. So this 4284 is the number which you are looking for, which the company has after the tax it has saved. This is the income which is company after the tax it has saved. So first is the net income. Then the second number, capital expenditure, how much company is expending in its raising for its capital, for its working capital requirement for next year, whatever next year operation it will do, how much capital it is expending in that, or and for future growth also, it may be buying some new plants, new machinery, that all data where you will get. So in screener.in you have to come to that cash flow statement. Here the cash flow statement, in cash flow if you come to cash from investing activity, the first one, fixed asset purchase, this is the number you have to see. This is March 24 data. Now next month March 25 data also will be there, so that data you can use. This is minus because the money is going out of the company. If it is plus means money is coming inside the company. Minus signs denotes that cash is going out of the company. Now depreciation, where you can see, so in profit and loss statement depreciation number is there. Depreciation you are adding because this cash is actually achieved, this cash is coming into the company. So cash depreciation will be plus, because here minus sign is there, outside minus, it will become plus. Now you have to minus change in non-cash working capital. This number also you can get from screener.in. If you come to here, cash from operating activity, if you click, working capital change number you will get. Plus number denotes that cash is coming inside the company. Now the last number, debt principal repaid minus debt, new debt issued. This also you can get from here itself, from cash from financing activity, how much borrowings have come and how much borrowings company has repaid. This number is minus, means money, cash has gone out of the company, and this number shows that cash has come inside the company. So this both number you can take from here. Now you are ready with the formula, and you can easily calculate free cash flow to equity for any company. Only thing is, two things you have to keep in mind when you are calculating. First is, as possible, use the latest data, that is the TTM data. Otherwise you will be in trouble, because if we are using 1 year old data, things may have changed. And the second thing is, for commodity and cyclical companies which runs based on economy cycles, you should normalize the data. What I mean to say, suppose you take a auto sector company, and you know auto sector is a cyclical sector because its profit and loss goes with cycles as per the economy. So what can happen, maybe the last year which you are taking the data, that will be the best year. So you have to average out, you have to take last 5 or 10 years data and then average it. That will be the best for these companies. Suppose Tata Motor I will take, and I will see that Tata Motor, the last year was the best year because company has generated a cash flow was 67,000 crore. But this is not the reality. This is a cyclical company. It will generate more, than one period will come where it will increase its cash flow, and then after many years it will decrease in cash flow. So you have to take an average of actually last 5 or 10 years, and that numbers you should use in your calculation while doing a analysis for any commodity and cyclical company, because commodity also companies depend upon the commodity prices. So that may be the best year which you are taking. So always normalize this data. Now we are done with expected cash flow. How to calculate the expected cash flow for this year, the first one. Now what about the next year? How to check that what should be the growth rate for the next year? So for that, three ways are there. First is to see the historical data. There you can see EPS growth rate. The second method is based on some analyst data, what they are predicting. For this you can refer a website called Yahoo Finance. And third is your own data. The most useful data which you can use is how much a company is reinvesting and how it is reinvesting. Because any company will grow if it is reinvesting its profit into its company. So that data, if you don't want to DCF valuation also, you should always see while buying any company whether its company is reinvesting in itself or not. Because reinvesting in itself always gives value, whether it's a human or a company. So always reinvest. Your money and your knowledge will grow. So growth rate. First thing, historical data. How to see EPS growth rate? Always see 10-year data. Don't see 1 or 2 year data. That may be misleading. That may be the recent trend, but that will not last for long. So always see what a company is doing in last 10 years. And growth rates will go down when a company will become larger. Always remember, when a company grows in size, the base increases and the growth rate also will decrease. And always normalize for cyclical companies like I shown you in Tata Motor example. So for a company, if you want to see 10 year, if you see Tata Motor, that growth rate is only 3%, whereas in 3 years it is showing 15%. So always take the 10-year data, how a company is doing in 10-year time frame. Suppose for Asian Paint you want to see, so in screener.in you come and see the 10-year data, 12% growth rate. This should be the number you should take. Otherwise, the second method is useful at Yahoo Finance. Finance.yahoo.com. You come out, select your stock, go to analysis section, and in analysis section go to growth estimate. Here analyst has estimated for next year 9.87% growth rate. This you can take. And the third Third method is your own data. How to use expected growth rate is what the company is retaining its cash in the company multiplied by ROE, how much return it's generating on that. So suppose a company is giving a dividend of 40%, so it has a leftover cash of 60% and its ROE is 20%. So 60% of that capital will generate a 20% return, means 12% growth rate will be there. So this 12% you can take. So how to know that? You can go to screener.in and see how much company is giving in dividend. So you can see 58% is the dividend payout, means 42% are left for the company to reinvest. Okay, that number you can use as a retention rate. Now the third puzzle, the last puzzle, is the terminal life. For how long you can add this cash flow? What you think, how long your company will go on, survive? It will survive because of its moat. Do it have some competitive advantage that this company will go on for infinite period, or this company may go 5-10 years and it will die, or somebody will buy it, or it may liquidate. So this is called terminal life. For how much long you can add this cash flow? Now you have cash flow, now you have growth rate. Now how to select the terminal life? So all good things come to an end, whether it's a high growth rate or a good products, everything has a life. Some new products will come, that same products will stop selling, growth rate will stop, it will start deteriorating. So you have to take a number. So suppose a company is there like Hindustan Unilever, where you think that company will go on for infinite period. Actual valuation should be from 1 to infinite the cash flow. The same formula here, for n period which we added, actually you should add for infinite period, but that is difficult to do. So you have to take a number. So we have three options. First is liquidate after some years. So add on for 5 years and then liquidate your company. Second is use multiples like PE. So suppose give a conservative value PE number which your stock is getting over a period of 10, 20, 30 years, and add for those numbers. Like suppose Asian Paint, if you see what is the PE number. So in here, if you screener.in, if you go and PE ratio, if you click, so here it will come that PE ratio, that almost you can see the lowest PE ratio will be around 50 and all. So this number is very high. So you can increase the period. Maximum you go, you will see that P ratio is around 19 also. So lowest P ratio you can take, and for that many years you can add. And the last is stable growth model. Suppose a company is going to be stable growth company after 5 years or 10 years. So for that many years you add, and whatever the last year expected cash flow, this formula you can use, that is expected cash flow divided by R minus G, where R is the discount rate and G is the expected growth rate. Discount rate we have already studied in chapter 3, and growth rate, here you have to take cost of equity because we are valuing equity only, and expected growth rate should not be more than the economy growth rate, because now your company is too large, it is stable, so it has to grow with the economy. So whatever Indian economy is growing, that same rate you can take, and this cash flow you have to take after that year. Suppose a company you think after 10 years it will be stable, so that last year expected cash flow you can keep here, and then you will get the value of the company. So these are the many methods of doing. But how a company increase its value? Suppose you don't want to do discounted cash flow model and all, just you want to invest in a company, but by looking at these parameters you can actually know that whether this company is doing well, it is growing its value, increasing its value. So these are the 5 ways a company grows its value. First is increasing cash flows. How it can increase cash flows? By cutting cost, by managing its inventory more efficiently, it can increase its cash flows. By increasing its operating profit margin, it can increase. So these are the ways. So if you see a company is increasing its cash flow, that is good. You have to be watchful. You have to see any company you are buying, always see with profit growth cash flows are coming. Just go to screener.in, and here cash flow section you see that cash flow should be coming and increasing. The Asian Paint cash flow was 1100 crore in 2013 and currently it is 6000. Whether it is matching with the profit growth also is increasing. Profit growth you see 1160 crore to 4000 5000 crore. Same big cash flow also has increased. But some of the companies you will see profits are increasing but cash flow are not increasing. Their trouble is there. So always look for cash flow is increasing, it's positive. Second thing is how to increase, or if a company is increasing length of high growth rate. For maintaining high growth rate is very difficult. So suppose a company can increase its length of high growth rate, that is very good sign. How you can judge that? Whether the company has competitive advantage or some brand name, some McDonald's, these type of brand names actually have moat and competitive advantage that they will they will maintain its growth rate for a very high period of time. Whether your company has any product or any service that is competitive advantage relative to other companies. Then the third one is whether your company is reinvesting and increasing its ROE. This number also you can see here. In screener.in, if you go, you can see that whether here from cash flow from investing activity, if you see how much cash flow is going for purchasing fixed asset. So here you see this number is growing, means company is putting more and more cash in reinvestment. So this number should be there in any company which you are buying. And ROE number also, if it is increasing, that is very good sign. ROE, ROC numbers should be increasing, especially for a smaller companies. Then if it company become more efficient by increasing its operating profit margin, this number in profit and loss segment, OPM margins are there, OPM percentage. Suppose these numbers are increasing, like if you see from 2013 to 20, this Asian Paint margins were increasing. So if a company can increase operating profit margin, that is a sign that it is increasing its value. The last one, decreasing risk, operating risk, default risk, and debt to equity risk, means more and more debts are actually a risk. So if a company is taking, it can take debt, but it should not be a very significant part of its equity. So this is overall things a company can increase its value. So with this discounted cash flow model, you can is completed. Now in next chapter I will talk about how you can value a company based on relative valuation model. You may be remembering that initially itself we have shown that there are three approaches. First is intrinsic value, second is relative valuation, and third is option pricing model. First one is completed. Now second one will start, relative valuation method based on P, book value, and other multiples. So hope you are liking this. If you are liking, consider subscribing and comment down if any doubt is there. I will see you next video. Bye bye.